You signed the papers, you shook the loan officer's hand, you drove home with the keys and felt like you had finally made it. What nobody told you that day is that you did not buy a house. You bought a payment, and that payment, multiplied by 360 months, will cost you $218,000 more than the price of the house. Hold that number, $218,000, not your down payment, not taxes, not insurance, just the interest, the fee the bank charges for the privilege of living in a house you are told you own. 6 months ago, I found a single line in Ezekiel's ledger, written in 1879, before the 30-year mortgage existed, before the Federal Housing Administration was created. Ezekiel wrote, "A house that belongs to the bank is not a home. It is rent with an illusion at the end." He wrote that 55 years before the system that currently owns your house was invented. And the Amish response, the system they built and maintained for 200 years, is the reason not a single Amish family in Holmes County has ever written a check to a mortgage servicer. I am going to show you every component of that system. And one calculation from the 1883 section of the ledger that reduces total mortgage interest by more than 60% without refinancing, without a lower rate, without any product a bank would ever sell you. Stay until the end. The last thing I will show you is the specific line on your own mortgage statement that tells you exactly how deep inside the machine you currently are. There is a number on your mortgage statement your lender will never highlight. You borrowed $300,000. Your monthly payment is $1,996. After 360 payments across 30 years, total amount paid, $518,760. The house cost $300,000. The interest cost $218,760. You did not buy a $300,000 house. You bought a $518,000 house, and the bank kept $218,000 of it. That number is disclosed, once in a table buried on page 4, in a font size chosen to be technically visible and functionally ignored, because if it appeared on a billboard next to every for sale sign in America, the mortgage industry's entire business model would require renegotiation. The Amish have known that number for 200 years. Their answer to it has never changed. The 30-year fixed mortgage did not emerge from market forces. It was engineered by government policy through the National Housing Act of 1934 and the creation of the Federal Housing Administration. Before 1934, mortgages were short-term instruments, typically 3 to 5 years interest only, with a balloon payment at the end. The FHA's innovation was to extend repayment to 30 years and to structure payments, so borrowers paid mostly interest early and mostly principal only at the end. This structure is called front-loaded amortization. The monthly payment became small enough to feel manageable. The total cost became large enough to generate extraordinary profits across an entire lending industry. Here is what front-loaded amortization means in practice. On a $300,000 mortgage at 7% APR, your first monthly payment of $1,996 breaks down like this. $1,750 goes to interest. $246 reduces your principal. After 12 months of payments, you have paid $23,952. Your outstanding balance, $297,024. You have paid nearly $24,000 and own $2,976 more of your house. The bank designed it this way, not accidentally, structurally. Rule 1. Ezekiel's ownership equation. When I reached the property section of Ezekiel's ledger, entries dated 1879 through 1891, I expected land purchase records and construction costs. I found those. But on the first page, before any itemized entry, Ezekiel had written a single equation, not a moral statement. An equation. Ein Haus, das der Bank gehört, ist kein Heim. Es ist eine Miete mit einer Illusion am Ende. A house that belongs to the bank is not a home. It is rent with an illusion at the end. He wrote that in 1879, 55 years before the 30-year mortgage was standardized. Rule 2. The barn raising model. The barn raising is not a quaint tradition. It is a financial instrument. When an Amish family needs to build, the community assembles, not as charity, as a structured labor exchange that eliminates the cost of capital. The family provides materials purchased with savings accumulated over years. The community provides labor, skilled carpenters, roofers, masons, at zero cost, because that labor will be reciprocated when the next family builds. In Holmes County, Ohio, a timber frame barn that would cost $85,000 to $120,000 through a conventional contractor is built for the cost of materials alone, typically $18,000 to $35,000. The labor differential, which in conventional construction represents 40 to 60% of total project cost, is entirely eliminated through community exchange. Apply that principle to residential construction. The median new home construction cost in the United States in 2023 was $392,000. The National Association of Home Builders estimates labor represents approximately 41% of that, roughly $160,000. Contractor overhead and profit add another 15 to 20%. The actual material cost of a standard new home is closer to $160,000 to $180,000. The Amish build at material cost. The $200,000 to $230,000 difference is the price of not having a community that builds together. That is not a religious observation. That is arithmetic. Rule 3. The phased construction principle. The third entry in the property section is the one that most directly challenges modern housing culture. It is a construction timeline for a family home spanning 11 years. Not 11 months, 11 years. The foundation and first floor were built in year 1, funded entirely from savings. The family moved in. Year 3, the second floor was framed. Year 6, interior finishing was completed. Year 9, the barn was added. Year 11, the property was fully realized. At no point did the family carry a single dollar of debt. This is phased construction, the exact opposite of the modern model, in which you borrow the maximum you qualify for, acquire the finished product immediately, and spend 30 years paying for the privilege of having it all at once. The modern model generates $218,000 in interest on a $300,000 loan. The phased model generates zero. The cost is time. Specifically, the discomfort of living in an unfinished space while the next phase is being funded. The mortgage industry did not eliminate that discomfort. It monetized it. They identified the gap between what people could afford and what they wanted immediately, and they filled that gap with debt at compound interest. Harvard's Joint Center for Housing Studies published data in 2022 showing first-time home buyers now spend an average of 28% of gross income on housing costs, rising steadily since 1980 as home prices outpaced wages. The 30-year mortgage did not make home ownership more accessible. It made the appearance of home ownership accessible while transferring the actual cost to the banking system in the form of interest. We are halfway through what Ezekiel's property records contain. The barn-raising model and the phased construction principle are the foundation. But they both require something most people do not currently have: an existing community structure and lead time to build incrementally. There is a fourth entry in the ledger, a calculation Ezekiel made in 1883 for a family that had to purchase an existing property with no time to build incrementally. The strategy he recommended reduces the bank's total interest revenue by more than 60% on a standard loan. Without refinancing, without a lower rate, without additional income, that calculation is coming. Rule 4. Starving the debt ledger. On page 47 of the ledger, dated 1883, Ezekiel recorded a calculation for a community member who had to borrow $2,600 at 8% interest to complete a property purchase. No time to build. Incrementally, no full community structure yet in place. He needed institutional debt, and Ezekiel helped him navigate it. Standard equal payments over 10 years. Total interest paid, $1,169. Same loan, same rate, but paying aggressively during harvest season and high-income periods, minimum payments during lean months, total interest paid $441. A 62% reduction through payment timing alone. No refinancing, no lower rate, no additional income. Just the strategic application of surplus cash to principal at every available opportunity. Ezekiel called this Den Hunger des Schuldbuchs verhungern lassen, starving the debt ledger. Here is the modern version. On a $300,000 mortgage at 7%, standard payment of $1,996 per month. Total interest over 30 years, $218,000. Add $200 per month to principal from year one. Pay off in 24 years, total interest $168,000. Savings $50,000. Add $500 per month. Pay off in 19 years, total interest $127,000. Savings $91,000. Apply one extra full. Payment per year, a single annual lump sum equal to one monthly payment. 30-year mortgage becomes 24 years. $47,000 less in total interest. One extra payment per year. The mortgage industry does not advertise this. The standard payment coupon has no recommended principal-only amount. The amortization schedule is not in your welcome packet. That information is not secret. It is simply never volunteered because every dollar of accelerated principal repayment is a dollar of future interest the bank will not collect. The incentive structure of the institution runs in the exact opposite direction of your financial interest. Ezekiel understood that in 1883. His neighbor paid $728 less because of it. What you can do this week. Step 1. Pull your amortization schedule. Every lender is required to provide it. Find the column labeled Principal Payment for your current month and compare it to the interest column. That ratio is your current position in the machine. If you are in year 1 or 2, you will find that over 85% of each payment is interest. Write that percentage down. That is Ezekiel's ownership equation made visible. Step 2. Calculate your accelerated payoff number. Use the Consumer Financial Protection Bureau's free mortgage payoff calculator at consumerfinance.gov. Enter your current balance, rate, and remaining term. Then add $100, $200, $500 to the monthly principal payment and observe the change in total interest paid and payoff date. The numbers will be significantly larger than you expect. Step 3. Designate additional payments as principal only. Call your servicer and confirm the designation process. Some servicers apply extra payments to future, scheduled interest by default, unless specifically instructed to apply to principal. This is not widely disclosed and costs borrowers thousands of dollars in unnecessary interest annually. Step 4. Apply windfalls structurally. Tax refunds, bonuses, any non-recurring income, directed entirely to principal. A single $3,000 principal payment in year 5 of a standard mortgage eliminates roughly $8,000 in future interest charges due to the compounding effect of reduced principal over the remaining term. That ratio, $1 paid now, eliminating nearly $3 of future interest, is what front-loaded amortization looks like running in reverse. The goal is not to replicate the Amish model in one generation. The goal is to begin starving the debt ledger today with the mortgage you already have. The mortgage industry will tell you your home is your greatest investment, that 30 years of payments builds equity, that you are doing the responsible thing. What they will not tell you, in year 1 of a standard mortgage, 88 cents of every dollar you pay goes to the bank. The 30-year term was not designed for your benefit. The amortization schedule is not shown on the day you sign. The cycle is profitable at every stage. Now, for everyone except you. Ezekiel wrote his ownership equation in 1879. A house that belongs to the bank is not a home. It is rent with an illusion at the end. I have nothing to sell you. I have his ledger, a government calculator, and arithmetic that has not changed since 1879. Look at your most recent mortgage statement. Find the line showing how much of your last payment went to principal. Write that number in the comments. Just the number. I read every single one. You now have Ezekiel's property system, the barn raising model, the phased construction principle, the interest inversion method, the tools to begin starving the debt ledger today. But here is what nobody tells you about the moment you start winning. The month your mortgage burden decreases, and that month you have extra cash. And the instinct every modern consumer has been trained toward is to spend it, to upgrade, to consume the margin you just created. That instinct is not accidental. It was cultivated by the same economy that sold you the mortgage. The Amish never developed that instinct because they never outsourced their food, their energy, or their basic consumption to a supply chain that prices everything against your inability to produce it yourself. Their household runs on a closed